We are diving into the passive activity loss rules under Section 469, a topic the exam frequently tests. The fundamental rule is that losses from passive activities can only be used to offset income from other passive activities. You cannot use these losses to reduce your active income, such as wages from your job, or your portfolio income, like interest and dividends. Imagine you have a $40,000 loss from a limited partnership interest. If you only have wage and interest income, that entire $40,000 loss is disallowed for the year. It becomes a suspended loss that you carry forward. The exam will try to trick you by testing the definition of a passive activity. Any rental activity is automatically passive by definition, unless you qualify as a real estate professional, which is a separate, complex topic. Also, any trade or business in which you do not materially participate is considered passive. Material participation is the key that unlocks your ability to treat losses as non-passive. While there are 7 tests, the one most commonly seen on the exam is the 500-hour test. If you participated in the activity for more than 500 hours during the tax year, you have materially participated, and the activity is not passive. Now, for the biggest exception, and a guaranteed exam topic, the special allowance for rental real estate activities. If you actively participate in a rental property, you may be able to deduct up to $25,000 of your rental losses against your non-passive income. Active participation is a lower bar than material participation. It means you're involved in management decisions like approving tenants or setting rent prices, even if you hire a property manager for day-to-day operations. However, this is where the exam sets a trap. The $25,000 allowance is subject to a phase-out based on your modified adjusted gross income, or MAGI. The phase-out begins at a MAGI of $100,000 and is fully phased out at $150,000. For every $2 of MAGI over $100,000, you lose $1 of the allowance. For example, if your MAGI is $130,000, you are $30,000 over the threshold. You would lose half of that, or $15,000 of your allowance, leaving you with only a $10,000 potential deduction. So what happens to any losses you can't deduct, either because you had no passive income or your rental loss exceeded the allowance? They are suspended and carried forward indefinitely. You can use these suspended losses in future years when you have passive income. The most important rule to remember for the exam is what happens upon disposition. When you sell your entire interest in the passive activity in a fully taxable transaction, all suspended losses from that specific activity are freed up. They can then be used to offset any kind of income, active, portfolio, or passive. This is the ultimate release valve for trapped passive losses. A related concept to remember is the grouping election. A taxpayer can choose to treat multiple trade or business activities or rental activities as a single activity if they form an appropriate economic unit. This election is powerful because it allows a taxpayer to combine hours from multiple activities to meet the material participation tests. To keep this straight for the exam, remember this simple phrase: pals can't play with the apes. Your passive activity losses, or PALs, cannot be used to offset your active income or your portfolio earnings, the apes. Keep this in mind to avoid the most common exam trap of incorrectly mixing income and loss types.